Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. Today's vibe, inflation is back in the group chat, oil is loud, and bonds are throwing a tantrum.
I love when markets throw a tantrum. It's like adults in suits discovering feelings. So what broke this time? Did someone say the word rate cut out loud?
Pretty much. We've got 4 stories in 6 minutes. US PPI surging, oil above $106, the dollar rallying on Fed hike views, and a reminder from the Cerebras IPO that AI doesn't repeal gravity.
Okay, start with PPI, because CPI is the one I pretend to understand at parties. PPI is, what, the pre-party?
Producer Price Index, prices businesses pay at the wholesale level. Market Pulse says US PPI surged to 6.0% year-over-year in April, and that heat basically derailed remaining hopes for 2026 rate cuts.
So it's like the restaurant telling you our ingredient costs went up, and then you're shocked your burger is $22, except the burger is my mortgage rate.
Exactly. When wholesale costs run hot, companies either eat it, hurting profits, or pass it on, keeping consumer inflation sticky. Sticky inflation makes the Fed cautious, which pushes yields up, which can push borrowing costs up across mortgages, auto loans, and business credit.
But wait, stocks were still up in parts of the coverage. How are we doing record highs while inflation is doing the Macarena on the table?
Because markets can hold 2 thoughts at once, AI-driven earnings optimism on one side and rate pressure on the other. When the inflation side wins for a day, you get the yields up, stocks wobble tape.
Let's talk oil, because nothing says calm markets like crude over $106. That's not a price, that's a threat.
Market Pulse also flagged oil surging past $106 per barrel amid Iran conflict risks and Strait of Hormuz disruption. Higher energy costs feed straight into inflation expectations, transport, manufacturing, even food logistics.
So the bond market is panicking because it sees oil and goes, great, now inflation has a gym membership.
That's actually a decent analogy. Bloomberg's markets coverage talked about inflation angst sending yields higher and dragging risk assets. If investors think inflation stays high, they demand higher yields to lend money, meaning bond prices fall.
I'm going to be annoying. Isn't high oil sometimes good for parts of the market? Energy stocks get a glow up, right? So why not just buy the dip in energy and call it a day?
Here's the pushback. Energy can benefit, but broad inflation pressure can hurt everything else: consumer spending, margins, and rate-sensitive sectors. If oil stays high, the winner trade can get crowded fast, and the overall portfolio still suffers if duration and credit spreads move against you.
Fine. Next, the dollar rally. Bloomberg says the dollar is heading for its best week since March on a Fed hike view. That sounds like the dollar is doing cross-it while everyone else is napping.
A stronger dollar usually means global money is chasing U.S. yields or safety. If markets price in higher rates, U.S. assets can look more attractive, and the dollar rises. The flip side, multinationals can face FX headwinds, and emerging markets with dollar-denominated debt can feel pressure.
So if I'm a normal person, strong dollar is good for my international vacation, bad for my international stock fund, and confusing for my online shopping cart. Perfect.
That's the practical takeaway, and it's why you don't want all your financial plans to assume falling rates. If inflation and oil keep pushing yields up, the cash and short duration looks smart again era can last longer than people expect.
Now give me the fun one, Cerebras. CNBC says it had a blockbuster IPO debut, and then the stock fell the next morning. That's like arriving at the party as the confetti cannon goes off, and then immediately the lights come on.
It's a clean reminder. IPO day is a liquidity event, not a guarantee. When a deal is blockbuster, expectations can get priced to perfection. Any wobble, profit-taking, valuation reality checks, or broader rate fears can hit fast.
I disagree a little. If AI is the megatrend, shouldn't we just accept the whiplash as the cost of admission? Like theme park tickets, but for your emotions.
Trend doesn't equal price. You can be right on the story and still overpay. If you want exposure, you can size smaller, stagger entries, or use a basket approach rather than betting your week's sanity on a single ticker.
Okay, that's fair. I'm reversing my take slightly. I want AI exposure, but I don't want IPO morning after exposure. My therapist doesn't accept stock charts as payment.
Quick action checklist for a PPI 6% oil $106 world. Keep a bigger cash buffer. Review variable rate debt. Consider laddering high-quality short to intermediate bonds, and stress test your budget for higher energy costs.
And if you're tempted to chase the hottest thing on your feed, just remember, hot is also what oil is. Diversify, so your portfolio doesn't become a campfire.
If this helped, subscribe for the next briefing and drop a comment. Are you positioning for higher for longer or still betting on cuts? This is BD Daily Finance News Podcast. See you next episode.